What's up, guys? Welcome back to another day trading video, and today we're gonna go over daily bias. All right, daily bias is one of the first things we ever do as a trader. When we hop on the charts, we collect data on our bias. All right, but how do we collect that data? All right, it's not simply just looking at the charts and the candles and simply saying, I think it's gonna go up, so let me take a long. I think it's gonna go down. I think it's gonna go down, so let me take a short. It's not about that. It's not all that. There's more complexity. There's 4 steps onto how you can do it, how I can do it, and how you will now know how to do. All right, so we're gonna go over this real quick because, like I said, it's not just about waking up in the morning. And if you just wake up at 9:30 in the morning when market opens and just be like, looks like it's gonna go up. No, 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 no. I suggest 8. All right, maybe 8:30. Like anything before 9. If you go after 9, you're like, okay, it takes me about 10 to 20 minutes to really, like less than 10 minutes to be honest, to really analyze pre-market, but that took years of experience. So for you, I would suggest anything before, any time before 9, all right, 9 a.m. or 30 minutes before market opens to really try to get an analysis. So if you woke up at 8:53, that's good. If you woke up at 8:20, analyze. If you woke up at 8:59, that's still good. If you woke up at 9:01, you're kind of being lazy. You have to push yourself to really be dedicated into this. But enough yapping. Let's go into really how do we get this daily bias. All right. Number 1, daily bias. All right. Finding a trend on the high time frame, going up or going down. This is so you can know where the market is going or making a pullback. All right. Where is the market going, or where can it make a pullback? All right, so you want to go into the high time frame, you want to go into the daily, the 4-hour, the 1-hour, maybe even the 15-minute or the 30. I primarily use the daily and the 1-hour. All right, so this helps me. So I go on the daily and see, oh, is a daily candle a green candle or a red candle? And based on my decision, I say, hey, it might end up in the green day. So if it's going to end up on the green day, I think the market is going to go up for the day. All right, so it's going to push my bias, and hey, we might want to take longs. But that's not the only thing I really decide to really take longs on. I also go on the 1-hour to really establish the trend. All right, so if I keep seeing higher highs and higher lows, then an uptrend like I did in a previous video. Or if I see lower lows with higher lows, lower highs, I'm pretty sure, yeah, then I know we're in a downtrend. So that's going to establish me to make maybe a short. All right, so if you want to copy me, I primarily use the 1-hour and the daily. All right, then we go on to step 2. Identify where price is delivering from in liquidity. What does that even mean? All right, we have liquidity. I taught you guys liquidity, highs and lows. So if the market previously touched the low and is now going up, we are delivering from that liquidity. We're getting delivered. All right, it's like me, I'm the price. I go here where the liquidity is. Boom, I tap the liquidity. I'm now delivered from the liquidity and go in the other direction because that liquidity boosted me to go in this direction. Now I delivered liquidity from here. Now I'm going back, forward, back, up, forward, up, down. It's very simple, but it's more just like going like this. I'll explain more briefly, but understand where you're getting delivered from liquidity from. All right, understand where it is. All right, is it taking or taken out a low or a high? All right, is it gonna take out a low? Did it already take out the low, or is it gonna take that high, or did it already take that high? All right, you have to understand this. I personally use just the 4-hour and the 15-minute. All right, so I go on the 4-hour and see, did it touch another 4-hour low or a fair value gap? Actually, we're gonna go over that real quick. So remember, a fair value gap, and I do that for the 15-minute as well. Did it take out another 15-minute low, high, and did it deliver from a 15-minute fair value gap or disrespect from a 15-minute fair value gap? And I'm gonna go over that real quick. Now we do need to go over fair value gaps, and I will go over those soon. As you can see here, this is what I mean when identifying where price is delivering from. All right, you can see, is it gonna take out this high? It may take out this high. Why? Because it's delivering from this fair value gap. This can be both on the 15-minute and the 4-hour. You can see price right here respected this fair value gap and now being delivered from this fair value gap, going out to take out this high, right? it delivered from this fair value gap, and is now targeting this liquidity high. As you can see, it's doing the same thing with this high as well. So what may happen is we take out this high, and then boom, we go down. So then we can in turn take a short, and that's, or if we just delivered from this fair value gap, we may be able to target these highs and take a long. So it's really up to your decision. All right. But I find it more better when you target liquidity. All right. When using just a fair value gap, that's not necessarily a like, which one is stronger, a liquidity or fair value gap? Liquidity is way more stronger. So I would wait for it to hit a fair value gap, and then target I wait for it to hit a liquidity, then target a fair value gap. Once it hits that liquidity, boom, I'm willing to take the shorts, where I can then target that fair value gap that was previously made. Let's say a green bullish fair value gap was made right now. So hit it, fair value gap was made. Now we target that. We take a short and target that fair value gap. Same thing with a red. You can see that it hit this fair value gap and now going to this liquidity point right here. Didn't deliver from it yet, but boom, then it then delivers. Just because it hits it doesn't mean it's going to deliver right away. It may just continue and then deliver. All right, you have to be willing to be patient for that, for when that happens. But like I was saying, you can see here, then it delivers, hits that fair value gap that was made. Now we target that liquidity, able to take a short on that. No, actually, we wait for that liquidity to get hit, then able to take a long, where another bearish fair value gap, since this is a downtrend, you would be targeting bullish fair value gaps. But since this is a bearish fair value gap, you target that as our target, take longs, deliver from this liquidity, and then boom. All right. You got to see if it respects a fair value gap, then target a high and low to catch liquidity, just to respect or disrespect a fair value gap. So you target highs and lows as liquidity, so you can catch the liquidity, to catch liquidity, just to see, so you can target that fair value gap. I need to write that down, but yeah, target the fair value gap to see if it respects it or disrespect it. Whether it respects it or disrespects it, it's still gonna test it. All right. It's still testing it. Whether it respects it or disrespects it, we're still gonna test that fair value gap, and that's why we want to really aim for that fair value gap most of the time. But enough about the second one. Let's go into the third one. See which fair value gaps get respected or don't. All right. Do they get inverse? So I'm gonna explain fair value gaps real quick. But if we to try to draw it out real quick, it's when the candle makes a hole. So let's try to draw it right now. You can see there's a gap, and what I mean when disrespects is, does it form a candle above it, or does it just form a wick in that gap and then head right back down? All right, or does it make a candle and disrespect it? All right, which one does it do? And so for the next video, I am going to explain fair value gaps, but I'm going to go off of the assumption that you do understand fair value gaps. But like I was saying, see which fair value gaps get respected or don't. Do they get inverse, showing prices going to the other way? All right, do they get inverse? So if we have a bearish fair value gap and it gets inverse, we're now bullish, meaning it's going the other way, which is bullish, up. Then we see 4, mark high time frame liquidity draws. All right, we want to mark the highs and lows on the high time frame because those tend to be the strongest. You could mark them up on the 1 minute, 5 minute, but no, 1 minute is like the weakest. I would recommend the 5 minute or the 15 minute, the 1 hour and the 4 hour, or even the daily. All right, these are good high time, but you can't just draw every high and low, You have to be willing to. You have to be willing to see the patterns of which they deliver from. If they have long body wicks, then they usually tend to be better draws on liquidity. But if it's delivering from a bearish fair value gap, you want to be looking for the lows. You want to be looking for the lows to be targeted, so we can bounce off of it and catch longs. All right. If it's respecting a bullish fair value gap, you want to be looking at the highs, because it's going to be targeting these high liquidity, and then boom, hit it, delivering from it, hit it, delivering from it, and going down. All right. That's how I personally use it. You can use it to target these liquidities, so you could take a long, hitting that liquidity point, and then you want to take a short. But that's up to you. You can either do one or the other. So there's really three options there. You can target liquidity, taking a trade to the liquidity, or taking a trade from that liquidity, or you can do both. Those are the three options you can do. All right, but you want to see if you want to mark out the high time frames draws. So set your target, so you take the trade targeting that. All right, I personally use highs and lows on the 5 and the 15 minute and 4 hour. You can use the 1 hour, but I tend to see that 5, 15, and 4 hour tend to get respected the most and better used for my strategy. It might not be better used for my strategy, but better used for me personally. So if you want to copy what I do, then by all means. But if you don't, that's honestly fine. All right, there's thousands of other strategies. There's hundreds of other strategies better than mine. All right, I'll admit it. There's way more strategies better than mine. But I like my strategy. I've seen so much success in it. I love it. I love my strategy. All right, I fell in love with it. I really have a sense. It's like a girlfriend in a way. All right, because I'm lonely. But but you want to target your let's get back to the main target. Set your target so you can take the trade targeting those highs and lows. All right, so go on the high time frames and target the highs and lows. Do not use the 1 minute. I promise you, most of the time they don't work. Set 5, 15, higher, 1 hour, 4 hour if you want to. It's all up to you. But I want to go over, there's three ways the market tends to move. Now these are the three ways, technically four. Four ways I tend to see the market moves, and you can see in my videos before in pre-market analysis what I think is going to happen, and I always show one of these. So I'm going to go over them real quick. Number one, we have previous session consolidation into new session. That is the New York 9:30 opening. So when I say previous session, that means London session before 9:30. So like I said, consolidation into new session manipulation and a reversal. So what I mean, we have Asia session highs and lows that haven't been touched at all. All right, that haven't since they haven't been touched. We regard the London session as consolidation. There hasn't been any manipulation that's been happening, so we just consider that consolidation. So they consolidate. Then I tend to react in this way. I tend to see if we're gonna hit the London session, the Asia session high or low to manipulate off of that. So we catch liquidity off of that, and then make a reversal into the opposite side, where we can then catch maybe the Asia lows or any other lows that we're able to catch. Maybe a 15-minute fair value gap low or a 1 hour low, 4 hour low. It really depends. All right, but I like to see 5 minute lows, 4 hour lows, sometimes five or 15 minute, no, 15 minute for value gaps, or most of the time Asia session lows. But as you can see, that is the first one. Then we have the second one, which is a bit of a part two, which has a bit of a part two into it. But real quick, we have previous session manipulation. In the previous session, it already manipulated it off of a liquidity already. So you can see here off of Asia highs. All right, so previous session manipulation, then we go into new session reversal right away. So you can see here, it hit Asia session lows, manipulated off of that, then into the new session, I'm expecting a reversal to happen. All right, this is when I expect. This is when a Asia session hasn't been touched, and for right here, Asia session low has been touched in London session. So I'm expecting in New York session, it touches it and immediate delivers off of that. Sometimes what can happen is this. It can sometimes happen where continues to go up. We deliver from Asia session lows on London session, or Asia session lows already delivered some off of some previous day liquidity. So we just continue to go up and up and up, and my light, and we just go up, ignoring all other highs liquidity. We just continue to go up, and that's been happening a lot of time. And the same thing can happen. We deliver from lows, highs. Sorry, lows from here, but highs from here, and then we just continue to go down. All right. This happens most of the time than this. I'm noticing a lot, but still, I still look out for these. You can see that sometimes I'm right, because sometimes in the previous market they tend to hit the Asia session highs and lows in the previous market, then go up, but then they sometimes what I tend to see happens after they hit it in the previous session, they go up, and then to the new session they go right back down. So for right here, so you can still see the previous thing that happens, manipulation, then reversal off of the opening. But sometimes I see that. But like I said, sometimes I see they both touch the highs and lows off a previous session. They go down into a New York session and then deliver right back up. Yeah, that's about what happens, right? Yeah, I think so. Yeah, no, then they deliver down. So go down, catch liquidity off of that into New York session. They go up a little and then they go down. All right, that's what I tend to see happen. But this is like kind of the most complicated one, to be honest. But still, I will still look out for manipulation. So one manipulation and then a reversal off the opening. All right. Then we have the third one, manipulation plus a reversal. This is my favorite, by the way. Plus a reversal, then into new session manipulation with continuation. All right. So what do I mean by this? This is just a little bit of manipulation, not crazy manipulation. And I'm going to go over that real quick. So what I mean is when previous market manipulated off of a high or a low, we tend to manipulate, catch liquidity off of that, then go up. Once we haven't hit anything into the new session, so we go up, right? As you can see here, we go up. Then we target a little bit of manipulation. That means a 5-minute low or a 15-minute low. That's why you look. That's why you want to mark highs and lows on the 5 and 15-minute. We deliver off of that 5 or 15-minute low, deliver off of it, and then go right up to for a continuation because it was going up previously from the manipulation of the previous market. And yeah, we just continuate off of that, targeting a high or a low. So you can see the same thing, but just in the opposite way. So these are the three kind of 4 ways because of this. This is I hate the most because it just goes up and up and up and up. And my strategy is a reversal. But still, you can if you can benefit off of that. You can still benefit. If your strategy is a continuation, then you can take longs or short off of the continuation that's happening. But yeah, those are the ways I look for bias. I hope you learn. I hope you now can target biases. That's it for today's video, guys. I'll see you guys in the next one, which is going to be a fair value gap video. But yeah, that's it for today's video, guys. Peace.